Good afternoon. Thank you for attending our webinar today. The topic is AML rules and alerts, testing, tuning, and best practices. I'm Brandy Reynolds. I'm the Managing Director of FinTech and Banking here at Bates Group. I have over 20 years of compliance experience, both on the AML and consumer compliance side. I would love to take a moment of your time to introduce our wonderful speakers today. So first up, we have John Ashley. John is Managing Consultant here at the Bates Group. John is a consultant with over 7 years experience in financial regulatory compliance with startups such as World Remit, as well as Econo Custody. He specializes in maintaining robust compliance programs, working very closely with U.S. regulators, and being a specialist in everything data privacy. We also have with us John Wythorn of the head of Financial Crimes Compliance at Gusto. John previously served as a BSA AML officer at Wise, where he oversaw financial crime compliance for North America. We also have with us today Lauren Day. Lauren works very closely with the crypto compliance world. She is apologize here. My computer is freezing up on me, so sorry about that. She is a compliance specialist with Ava Labs. She is an experienced AML compliance expert working in virtual currency industry. She is a certified anti-money laundering specialist. And we, last but not least, have Robin Garrison. She is the Strategic Innovations Director of Compliance at FirstBank. Robin is also a certified CAMS audit specialist. She works with fintechs, MSBs, as well as on the banking side, working as risk management expert in banking as a service. She's worked in the industry for over 14 years. We welcome our wonderful guest speakers today. So with that, I would love to turn it over to your moderator, John Ashley.
All right. Brandy, thank you very much for the introduction. Hello to everyone in the audience. Welcome to our webinar today. Before we get started, a couple of housekeeping notes to discuss. First off, the webinar is being recorded, and you will receive a link to the recording shortly after the webinar has concluded. We will be taking questions at the end. We welcome audience participation, so please use the Q&A function in Zoom to post a question for the panel. We will respond to all of those at the end of the webinar. And with that, let's dig in to AML rules, testing, tuning, and best practices. So, as compliance professionals, we think about all aspects of meeting our fundamental legal obligations, which is to identify and report suspicious activity. One of those fundamentals is the concept of the business rule. The business rule is the basis for our models of transaction monitoring. They allow us to identify actually suspicious activity while we are sifting through all of the raw data that we have available to us. This can come in many forms, from filtering Excel spreadsheets and CSV files, building out models of suspicious activity described in typologies or similar documents, looking at exposure and association, who the customer has interacted with in the past. From the standpoint of a bank, this might be who of the bank's customers has this customer had transactions with. From a crypto standpoint, this can look at what is their wallet history, and what the what that entails for the financial institution. We can go even deeper into this, looking at behavioral analysis like interaction with your platform. This is everything from monitoring their login activity, looking at IP addresses, uses of VPNs, looking at their history of payment methods, even stuff as deep as looking at their interaction with your human or AI customer service agents. However, this is all well and good, but regardless of how we set them up, our rules have to be risk-based. This means a lot. Fundamentally, though, this means that our rules have to be appropriate to business models. For example, rules that apply to an institution that has physical locations probably won't have much applicability to a business that is online only. It can apply to your target customer base. Certain segments might have more inherent risks over others. And it can apply to the products and services you offer. One of the most basic differentiators there is, how do you accept payments? Cash has different risks as opposed to payment with cards versus payment with ACH or other bank transfer methods. So when we think of these business rules, how do we start? Well, we have to begin with the idea that we're looking at activity. Activity is fundamentally a behavioral topic. So when you design your business rules, you're trying to look at activity that is outside of what you expect to be normal for your customer base. This can take a wide variety of forms. It can be everything from transactions that exceed what you expect to be the normal dollar amount or volume that that customer segment might exhibit, patterns that just plain don't make sense, like someone making multiple transactions rapidly and incurring multiple fees. Well, why didn't they just combine those into one transfer? And even things like account history that shows strange patterns, constant requests to cancel and refund a transaction, particularly if your refund is going to different destinations all the time, or rapid movement of funds in and out of an account if you're a bank. That doesn't make sense. Why is this person constantly receiving $10,000 and then sending out $9,900? So your rules should target known typologies. We'll go into this in a lot more detail later, but when we talk about known typologies, this includes everything from your past experiences, your industry's particular best practices, as well as what you observe in the ordinary course of business as just plain weird. And above all, your rules need to be efficient. They have to document, they have to be documented, they have to be updated, they have to correspond to what you are actually observing. They shouldn't be things like a subjective review, like giving an analyst a 10,000 line CSV and saying, go find something that looks odd. Or a checklist that just says, okay, pull up a transaction, look for these things, and if you see something weird, let someone know. They have to be based on definitions. What is the suspicious activity we're looking for? How can we logically describe it in terms of movement of funds? And fundamental thing is that your rules, and we'll get into this in a lot more detail later on in this webinar, but your rules are never permanent. They are not set in stone. Going off of this thing, I'd like to throw to John here and ask, we talked about this idea of your rules have to be documented, formalized, and so on. Let's say that you're in the position where you have an institution where there's good practices in terms of finding suspicious activity, but none of it's formalized. So how do you go from the stage of just okay, look at the spreadsheet to actually formally documenting things?
Ooh, thanks, John. I think that's an interesting question. I don't know that I've ever seen a good program where they haven't had formal rules, where they're effectively capturing suspicious activity. But that said, it does happen, right? If you are a small institution, or maybe you're a fintech and you have very low volumes, it's possible that you're doing account reviews. It's possible that you have some very broad formal reviews where you're looking for just volume variations and then looking at it. So I think the challenge of figuring out what typologies you need to be looking for your institution comes from a couple of different places. For me, my approach is always starting with your risk assessment. If you don't have a risk assessment, you should do a risk assessment to really understand the financial crime risks of your institution. So understanding the types of products you're offering, the geographical location of your customers, the types of customers, the channels in which you're dealing with those customers and how the money is moving. That'll determine the likely typologies you're going to find, whether it's fraud, money laundering, terrorist financing, whatever it is that you want to detect. And then you set up as broad rules as you can to capture those things. You test them, you tune them, and then you narrow things down. One thing you mentioned is really important is you can't really just go off the shelf, I think, for most institutions. I think there's this tendency to want to be like, oh, this program comes with 20 rules. We'll just launch those. And it's like, yeah, but if it's about cash deposits and you have an online only business, maybe 5 of those rules are really not useful.
Those,
And
yeah,
one,
those are both two great points. And we're going to talk a lot about the risk basis for rules and particularly about that off the shelf piece later on in the webinar. Lauren, Robin, your thoughts?
All right, well, I will jump in, and I know that I'm going to talk a little bit about this here on the next couple slides, but I am a huge proponent of documentation and process, and not just checklist process or doing things because we are told that we have to do them. So depending on your institution, the maturity of your institution, I think it really does span the spectrum of what you can expect. You know, an early stage fintech is going to look very different than a $15 billion bank in terms of what we're going to have. But overall, whatever documentation you have and whatever business rules you come up with, like John said, making sure that you're documenting that those are appropriate in the process that you're using to tune those rules and how frequently you're doing it. I mean, that documentation is really critical. And I often see institutions where I sit down and I talk to them and I say, okay, tell me about how you tune your rules. And they can tell you, but then I say, okay, show me your documents or show me the process you did. And they can't do that. So if you didn't document, you didn't do it. So documentation is really critical here.
Yeah, and I'll just double down on John's point about doing a risk assessment upfront, even for fintechs and crypto firms. Laying the groundwork with a risk assessment and documenting that is super important to say, okay, this activity for our firm in particular is the most high risk. Therefore, we need to tune the alerts to capture this high risk activity that meets our actual firm's activity.
Yeah, great points, everybody. It's pretty obvious to see that having accurately modeled, tuned, and tested business rules is essential to a robust compliance program. Just last year, there were 3 very high-profile instances of enforcement actions against USAA, Shinhan Bank, and Coinbase. At the core of all 3 of those was the finding by the Department of Justice or whatever other enforcement agencies were involved that there was an excessive backlog of alerts. Suspicious activity was not being appropriately identified because of the backlog of alerts, and the alerts were producing an excess of false positives. Over and above what we can, identify from reviewing these enforcement actions, regulators are taking a very keen interest in the risk basis of your transaction monitoring program. For those of you in the audience who are state licensed or state supervised institutions, you all have the experience whenever the state regulators come in, they will test your transaction monitoring program. That is part of the examination process. New York is, as we are probably all aware, the strictest here. The first and so far only state regulatory agency in the US to codify the requirement for a risk-based transaction monitoring and business rule setup into the legal force of regulation. So this really goes to show is that your business rules and the way that you manage them reflect the risk basis, as we've all talked about, and we're going to keep talking about, of your compliance program. And this is something that your external stakeholders are going to look at, whether you're a regulated institution or someone who is primarily responsible to a sponsoring bank. This is key. Robin, on that note, I kind of want to throw to you on this. Talking about this idea of risk basis in your your building and testing your transaction models. What are some of the things that you've seen, especially as it may or might relate to New York Part 504 and the requirements that come out of that?
Yeah, this is a really fun topic, as fun as AML tuning can truly be. But it's really interesting given where we are in the industry today, and especially considering a lot of what's happening on the bank as a service side, which is where I predominantly sit. And when we talk about money transmitters, any bank-sponsored money transmitter program where they're standing in for licenses, this is really becoming a very big inflection point. I mean, we've seen a number of consent orders come out of the bank as a service space, specifically related to BSA recently. And so I think this is a wonderful, wonderful topic. We're not going to have enough, time to talk about. So in terms of what the rules are, NYDFS 504, model validation, whatever your sort of paradigm or your regulatory obligations are, I think there's a lot of best practice threads that run through all of these regulations. And they all kind of boil down to, an understanding of what you are, where you sit in the payment flow, what your obligation is, and what your process for managing the risk of that seat that you hold. A money transmitter is going to have a very different risk profile and very different rules than a bank as a service platform, than a payment aggregator, than any of these other things. And we use the term fintech to refer to pretty much anything with a digital channel now, which is it's honestly not very helpful because we paint with a very broad brush. But what these regulations really help us to do, and I know that no one likes to do the paperwork on them, they're a huge pain in the butt, but what they really help us to do is the groundwork for what are we? What are our risks? How do we handle those risks? How do we document those risks? And what's our process for reevaluating those risks? Because often we see that you may do all the legwork up front, but if you're not reevaluating who you are, what you are, who your customer base is on a regular basis, and making sure that's getting into your overall risk profile and in your documents, you may actually be missing some really critical pieces of your AML program. If you guys, I saw the attendee list, we kind of span the gamut, but fundamentally, if you're an AML professional and you do not understand your flow of funds, and you do not understand how your program can be used to launder money, and haven't sat down and thought about all the ways that you would launder money through your program, you haven't done the legwork to even begin to comply with NYDFS 504 or model validation. So I think these are phenomenal regulations, but I think more importantly, the best practices that are behind them of thoughtful, analysis, iteration, and change management. Even if you're not subject to any of these regulations, you should look at what they say and try to bring in some of those threads of best practice into your business.
Yeah, those are great points. Lauren, I want to ask you specifically from, we have a very prominent crypto firm here on the list of our case studies, Coinbase. Can you speak a little bit about what that enforcement action, what are the takeaways from that, going back to Robin's point about understanding the flow of funds and the particular money laundering risks that a firm is exposed to?
Yeah, I think the Coinbase settlement case is a prime example of the importance of doing the testing and tuning alert up front so that you don't get buried under this mountain of backlogged alerts, and then you're missing the genuinely suspicious activity. So to get into the specifics of the Coinbase case, in 2020, they underwent an exam of their 2018-2019 compliance program. They basically found that there was a backlog of more than 100,000 alerts, which is huge. And at that point,
yes.
yeah, at that point, it's overwhelming because you can't even begin to pick out what is the genuinely suspicious activity. So it's getting lost. And then, so as part of that settlement, they had to pay a $50 million fine, as well as a $50 million remediation. So that means they have to hire more compliance people. They have to hire an independent audit firm to oversee this activity. And then they also found in this exam that the third-party case management system they were using was inadequate. So two takeaways here is that do the testing and tuning up front, because it's going to save you a lot of headache down the road when you have this huge mountain of backlog. And then the importance of choosing the right vendors. So, being able to have a vendor that can adequately address what you're trying to do can make a huge difference.
Yeah, no, that's great. And we'll definitely dive into that more as we get deeper into the webinar today. Fundamentally, the thing to keep in mind is we talk a lot about, using phrases like risk-based approach, risk assessment, mapping, model validation. There's one thing I'd like, the audience to take away from this. It's this. Your compliance program isn't static. It's not something that you write down, you set up, and then you build a monument to it and walk away. Because your bad actors are going to look at that and they're going to find a way to immediately go around that and exploit your products and services for their illicit ends. So let's dive deeper into this discussion of the risk-based approach, which has been one of the sort of themes we've been developing for the past 15 minutes or so. Risk-based approach is really critical when you're trying to design your business rules. It's critical because you need to remember one size doesn't fit all when it comes to business rules. When you're designing your rules, a lot of us come from very different backgrounds, different experiences, and so on. And it's important that, to remember those experiences are definitely invaluable for all of us as compliance professionals. But we have to remember to always take an objective eye when we are trying to design our rules, so we don't end up incorporating rules that aren't appropriate to your business model. Some examples are an online business rule shouldn't have necessarily rules around cash reporting, because an online business, with some exceptions, obviously, but most online, fintech and payments companies don't accept physical cash. So you can look at this and say, all right, do we really need to have CTR rules in place around this? Another example is making sure that your thresholds are applicable to your regulatory requirements. Maybe you come from, a regulatory regime where there's a reporting threshold around transactions that are, let's say, $6,000. Well, if you're in a different regulatory regime, do you really need to have that rule in place, or is it just creating extra work for you? And also, going back to something that all of our panelists have noted is, if you're using software, this is not plug and play. This is you cannot simply run an out of the box rule configuration. You have to make sure that rule configuration is actually doing something significant. We'll dive into this a lot more later on in the presentation. Lauren, want to come back to you. You talked about this a little bit when you were discussing the details of the Coinbase settlement, but can you sort of speak to some best practices you would identify for firms that are trying to go from the status of, okay, we've identified a risk profile, how do we get that to something actionable?
Yeah, so I'll say I'm looking at this through the lens of US-based crypto exchanges, or MSBs. So in my experience, AML rules or typologies are the same in crypto. So we're going to look at volume and velocity, but then we have an added layer of being able to look at blockchain data. So going back to what everyone else has been saying is that it's really important as a compliance professional to understand the products and services that your firm is offering. So really deeply understand what is the risk associated with these products. What would look like suspicious activity with crypto, for example, volume, velocity, but as well as which jurisdictions are we servicing. So that's really important, especially considering crypto is so global. So which jurisdictions are we having the most customers from? Are our customers retail? Are they institutional? Because that will affect, retail volume we'd expect to be lower than institutional volume. And that will affect what kind of thresholds we'll put into place. As well as being an MSB in the US, you have to consider that the SAR threshold is $2,000, for example. So taking into account which jurisdictions you operate in, what your product types are, as well as your customer types and what their expected activity should be.
Yeah, no, that's very good points. Robin, from the banking side of things, how would you, weigh in on that question? Going from, okay, we have a risk profile here, to implementing it.
I think that in banking, it's sort of a double-edged sword, where the wonderful thing about banking is we have a lot of data. We, for the most part, the banks have been already operating. We have a lot of historical data about our customers. So we're kind of able to, when we design new rules, we're able to cut out a lot of the legwork to say, okay, what does suspicious activity look like at the bank already? That, however, cuts the other way when we're talking about launching new digital channels and new innovative products, because we may be over-reliant on what that customer base looks like, and not able to effectively apply that historical learning for those new products. And that can be a pretty big challenge. I've noticed, especially for institutions that are not used to being exposed to these types of new technologies, is They just don't have the basis, the framework to evaluate what the rules should be. And one of the challenges that kind of presents is that it can be an over-reliance on controls that are no longer effective. And that's where I'm always, even if I feel like I know a product or I know what the customer base is, I always like to challenge those assumptions on a regular basis and say, why do I feel like I know what I know here? Do I have good data? Am I applying the right data set to drive a really good risk-based approach? Or does the current risk-based approach that I have actually support this new business line? And, kind of coming back to bank as a service again, because that's, sort of what is hot in the market. That is what we are seeing, is we're applying the current risk-based approach for brick and mortar banks to digital channels, and it's just fundamentally breaking down. A rule that I've seen applied at multiple institutions is structuring. We get an alert for $10,000. Well, why is that important for a digital channel? The answer is that's actually not a good rule, but it adds a lot of noise. And so we're not able to really effectively tune it if we're using that old set of rules.
Yeah, no, and that's a great point, because one of the reason we talk about and we use this phrase risk-based approach constantly, and it might seem like it's, some sort of mantra, but like, if you don't take this, like, some of the side effects you can have can be very unpleasant. You can have overworked staff, and for those of you in the audience who are compliance officers or directors or who are in similar positions, it means that you don't have the ability to forecast staffing needs appropriately, because you're looking at just a mountain of work with no idea as to what is realistically useful in there. And a lot of this comes from the fact that if you don't configure them appropriately, your alerts will give you a huge amount of false positives, and you could spend decades trying to get through them. And both of those circumstances lead to scenarios where you're spending so much time focusing on this mountain of work that the bad actors are slipping under the radar. And we'll get back to this later. And then you get into, the knock-on consequences to this, which are now the regulators are looking. You're in examination, with FDIC, OCC, whichever state Department of Financial Institutions regulates you, other regulators, and they're looking at this backlog and they're saying, why do you have 100,000 alerts, and what is your plan to remediate them? And they're going to focus on both of those, but they're really going to focus on how did you get to this in the first place. And that is a situation that, as a compliance professional, you really don't want to be in, because it questions the whole assumption of, are you operating the business in a safe and sound manner vis-a-vis your compliance program? John, wonder if you could chime in on this. What are some of the warning signs if you're, like, say, a compliance officer or BSA director, or someone in that level of the corporate structure? How do you start to see when things are about to go off the rails, and what can you do to prevent it from getting to the point where a regulator is putting this in a report?
Oh, yes. How do we stop the train before it leaves the station? Always the question. I think one of the things, you touched on a number of them, and I think Robin and Lauren talked about it too. The backlogs don't appear overnight. And if they do, it's probably a one-off, and you can remediate that in a pretty fast time. But they tend to creep up over time because either you're understaffed or your rules are not tuned properly, or, as we've discussed, they're not tuned for what your actual product is. Robin uses a really good example of structuring rules, which can be, if you write just like a plain structuring rule, creates tons of noise. I remember at a previous company I was at, we had a lot of international payments, and we built some structuring rules. And when we were testing them, we got hundreds of thousands of alerts. And immediately, the first thought was, oh my gosh, all of our customers are criminals. This is terrible. What is going on? But then when we actually looked at it, we had to realize that our international customers, we had product restrictions that required them to break up payments. They actually couldn't send larger payments. So in fact, our company was saying, oh no, you need to break that up into 10 payments, because we can't send it as one. So I think there's the way you prevent it from happening is you have to make sure that you actually have a really good structure in place and governance. So this is really understanding, Here's how we develop the rules. Here's what we're fighting. Here's what we're not. And then to avoid the report from regulators, I'll share my secret. And I don't know if anyone else has stumbled upon this secret that at least I think I've discovered. Regulators are not concerned if you have a backlog. That is actually never the issue. And the 3 examples you put up there, the issue wasn't that a backlog existed. The issue is that the regulators came, there was a backlog, and the response of the institution was, don't worry, we're going to fix it. And they failed to fix it, or they downplayed or minimized the risk the backlog presented. I always tell my staff and my leadership team, if we have a backlog, it's not an analyst problem, right? It's not the operations teams. It's not their fault. It's incumbent upon us as leaders within the institution to make sure that we've tuned our rules and we've hired appropriately. And you can't hire 1 million people. My board is never going to give you that kind of money. That's just not going to happen. So you have to really make sure that your rules are tuned appropriately. And when you look at all of these consent orders and these issues that have come down from regulators in the last 12, 18, 24 months, it's typically the remediation was poor. There was no strategic plan to tune and focus the rules. Or to Lauren and Robin's point, sometimes the institutions themselves haven't figured out what their core product is and what the risks are and what they need to actually detect.
Yeah. Lauren, Robin, love your comments on John's thoughts here.
I think it's impossible to fix the problem, kind of like John was saying, by just throwing people at it, because that's not resolving the root issue, right? It's a lot of firms have done this in the past where they get hit with a remediation plan and they just hire dozens of compliance people to mindlessly clear alerts, but that's not addressing the problem. And at the same time, you're not finding the genuinely suspicious activity. If you're just hiring people to mindlessly clear alerts, that's not solving the root problem of testing and tuning and making alerts that capture the suspicious activity that you do want to find. And then just going back to my point about finding the right vendors, the best vendors I've seen for compliance alerting are the ones that allow you to do the tuning and testing and show you the results without, pushing things into production. So you can test changing an alert and see what the implications would be. And, are you capturing the activity you want to capture by testing?
I think that's a great point that Lauren just made about vendors as well. And, kind of double tapping on making sure you're capturing the right stuff. We have SAR data at our fingertips. We know what suspicious looks like at our institutions, or if you're getting started, maybe you work with a consultant who can give you that. And I'm not talking about, Robin Garrison moved this money through and we reported a SAR on her. But what I'm talking about is we understand what money laundering could look like and what data elements, what the sort of, combination of data elements can look like for different typologies. That is phenomenal data for questioning your underlying assumptions of your rules. And so you can use your fraud data, which I know there's still a lot of argument about FRAML or not FRAML. We can fight in the parking lot later about that, but
or in a couple of slides.
In a couple of slides. But I think that, using the data that is at your fingertips, or the knowledge that you have about what that can look like, can also help to either change the assumptions that you have, prove them wrong, or prove them right. And if you're looking at, let's say you've got a really low alert to SAR ratio where you're burning through time and you're burning through people. I mean, you really need to be taking a look at those rules, because you're checking a box. You're not actually doing what you need to do. And there's a really good chance that something else before the rules, there's something else further in the chain that is broken.
Great points. Speaking of fraud, so let's get into the weeds a little bit here and talk about, okay, we've discussed the value of this. How do you actually do it? How do you actually test and tune? Real quick before we go into this, my sort of thoughts, and the panelists are free to jump in on this, but testing, this is the process of using data to determine the effectiveness of a rule that you're trying to propose. Tuning is tinkering with the model and the logic to try and make the rule more accurate to what your expectations are. And obviously, when you're tuning, you'll also probably test, because you're going to be using data to see, okay, I make this change to the logic. Is it going to result in my expectations? One of the biggest sort of gaps I've seen, professionally speaking, is when you are testing and tuning, there is a tendency to be locked into the data that you are used to seeing as a compliance person. To Robin's point, maybe you should consider talking to your fraud people, because they see things in a much different light, real time versus post transaction monitoring, and they might have some other insights. Myself, I have found a huge amount of benefit from talking to the people in operations and customer service, the people that are actually like very close to the funds flow and the customer base. And, make sure that you think outside of what you're used to seeing, your alert workbook, your alert queue, whatever that happens to be. And another thing you have to consider, and this is really fundamentally important, I would say, is what are the metrics for how the rule should succeed? How are you going to say whether or not the rule is working correctly? We touched on the alert to SAR generation ratio, which is a great metric to use. Alert clearance time is another one. How often does it take your analysts, or how long does it take your analysts to get through the alert? And also, how many false positives are your analysts reporting to you in terms of, hey, we're spending all this time and it doesn't seem like we're getting a lot out of this. So, thinking of that, the other last thing to remember is, going back to an earlier point, how are we going to look at the data, the givens that we have? Again, we might think of this from a pure compliance standpoint of, okay, various attributes of a transaction, but depending on the complexity of the institution, you might have other data. If you're looking at it from Lauren's perspective, you might have blockchain wallet history. You might have stuff like IP activity, client activity within the account, and so on. Robin, you talked a little bit about this earlier, but I'd be interested to hear your thoughts regarding, the challenges of doing data analysis, data inventory, data integrity, and how that all feeds into the transaction monitoring process.
I could talk about this for hours and hours and hours, but I don't have that much time. However, I will say that I think that data is one of the most overlooked but fundamental pieces of AML, BSA, CTF, whatever acronym you're using today. Data is a phenomenal resource for us to have to both ingest into our transaction monitoring system, validate it, tune it, all of those things. But I want to give a big caveat to this, because I think there's actually some other challenges that are only just now becoming sort of talked about in the industry. And those are around, understanding how the data is getting into your system. So I like to talk about how the financial services industry is really and truly fractured right now. Whether that's a good thing or a bad thing, I think we're in the midst of a revolution of sorts. But essentially, we've got, if you want to launch a product to market, you may have a banking partner, you may have an international money transmitter partner, you may have a digital wallet partner, someone's developing your app. I mean, these are all considered data points into your system. And understanding, which this is a challenge for me as a compliance professional, because I'm not trained in data. I'm not, I've sort of fumbled into this, but understanding how that data gets into your system, how it's cleaned and maintained, is really important before it even hits your transaction monitoring system. Because what is concerning is if we say we've got all these data-driven rules, aren't they fantastic? Well, if your data is not being maintained correctly, and if, for example, you've got a vendor in the middle that's truncating a field in their API, so instead of it being 8-digit or 9 digits, it's 8 digits, you could actually end up with some critical failures in your transaction monitoring system that you are completely unaware of. And in some cases, that can result in failures to collect CIP, to report. I mean, there are some pretty big outcomes that can happen that can be really devastating to your company for over-reliance on both having the data as well as the quality of data. So one of the things that I've started doing in the last few years, and I highly recommend that everyone on this call learn how to do this. It's really, really basic. Get a, write on a whiteboard or get an Excel spreadsheet, map your data, understand where it comes in the system, who handles it, what they do with it, and then create essentially a data library of all the data points that are available to you. And it'll help you understand, hey, I've got another data point over here that I can use and I feel good about it. And that will enable you to design some really amazing rules, but also understand some of the brittleness in the rules that you have.
Yeah. No, the little privacy analyst in the back of my head is jumping up and down, shouting data inventory, data inventory, data inventory right now. Want to move along because we're getting a little bit close to time here. So when we're going about implementing our new alerts, it's really important that we think strategically about this process, pre and post implementation. While you are in the process of building out your rule, you have to make sure it's understood by key stakeholders. And this is not just, although it definitely is, your compliance analyst staff. This is also your operations team and probably also your customer facing, customer success, customer experience, customer service team who will be impacted by this. Everyone needs to understand to the level that is required what the impact of this rule is going to be and how to deal with it. If you're a customer service person, it could be as simple as saying, there is a new rule in place that does this, you tell the customer that. If you're an analyst, it's, hey, this is the new rule model, here's the logic, here's how to interpret it, here's the triage and review process. Also, you have to talk to whoever is building the rule for you, whether this is your contacts at the vendor that you're using, or if you're building your rules engine internally, your IT team, your engineers, and so on. They also have to understand this. And when you are building this, you also have to test it. You have to use your data that you have available. You can use dummy data. You can use like segments of actual transaction data over a period of time, but you have to do some sort of testing to make sure, okay, is this behaving the way I think it should in the test environment, with the knowledge that the test environment is not the same thing as the real world. Then, once you've done that, you release the rule into the wild, as it were. You have to monitor it. You have to look at how it's performing. Sample its activity, look at what is it giving us in terms of results. Talk to your analysts. What is it like working on the new model? How efficient is it? How do you feel how confident do you feel about being able to triage this and review it? This can allow you to think about things like, okay, do we need more training? Do we need better descriptions? Fundamentally, once you turn the rule on, you want to understand two things. How does it actually work in the real data environment? And is this what I envisioned that it should work as when I was designing? Lauren, love to get your thoughts on your approach to designing rule logic and best practices you can share with the audience here on both of these phases.
Yeah, so first, the importance of cross-departmental cooperation in doing this work cannot be overstated. So I'll use the example of integrating a blockchain analytics tool with a crypto exchange. So in my experience going through these exercises, this is a full team effort. So I've had to work with product, engineering, customer success, and you have to make sure everyone is on board and understands why we're doing what we're doing and what we're doing exactly, because this helps us make sure that the integration is correct. Kind of going back to Robin's point about if we're not sending the correct data, then we're completely missing the mark. And so the engineers need to understand this is the exact data that needs to be sent in this format to be screened properly. So yeah, cannot overstate the importance of building those relationships and making sure they understand why we're doing what we're doing, and you know, the importance of how this flow is built out. And then on the product side as well, understanding, for example, if a sanctioned actor deposits or interacts with your platform, they need to understand that we need to freeze and report this transaction. So building in those mechanisms, technically, like I'm not an engineer, but the engineers need to understand that we need to have an automated mechanism to freeze this transaction if need be. And they need to understand why we're doing that. And usually, you know, if you're explaining sanctions, they get it pretty quickly. But I think that's a huge piece first, is just, and making sure it's also a good user experience. So on the flip side, you know, understanding that we don't want to create too much friction in the user experience, but at the same time, we want to catch the genuinely suspicious activity.
You bring up a good point that I want to follow on. Sorry.
No, go ahead.
You bring up a really good point that I want to follow on. Like you said, that sanctions is something that everyone understands. When it comes to stuff that isn't sanctions, how do you go about the process of that education? You know, letting people understand that it's not just like this sort of like black and white legal obligation.
Yeah, that's a good point, because there is that differentiation between sanctions is very black and white, but we also have AML obligations to stop money laundering and things that may fall below the sanctions threshold, but are still important to capture. And that's, you know, I've had the privilege of working at smaller crypto firms, so I've done a lot of just company-wide training where I get into, these are the BSA AML obligations we have, and this is what we need to do to meet these standards. And so it's a lot of just conversation, honestly, and the biannual trainings we do that we're also required to do to help that make sure everyone understands this is why we're doing what we're doing. And to this point, so integrating a blockchain analytics tool, the first thing we look at is the categories. So prioritizing what are the most severe risk categories that we want to capture in our rule set. So this going back to doing a risk assessment first. So obviously sanctions are most important, but maybe stolen funds or fraud or CSAM are other high severe risk categories that you want to include in your alerts. So that's the first step, is just understanding what are the most severe risk categories we want to address, and then breaking it down from there. For example, gambling, sometimes some firms consider it medium risk, some firms consider it higher risk. So understanding what is your firm's risk tolerance before you set those rules by risk category. And then another piece, this is maybe a bit unique to blockchain monitoring and crypto transaction monitoring, is the idea of indirect and direct risk exposure. So obviously direct exposure is the most high risk. So if a sanctioned actor directly deposits to your platform, that's the most high risk. That's very direct, but it gets a little bit of blurred lines when there's indirect risk. Say that the sanctioned actor was 10 hops ago, or 10 transfers ago on the blockchain. You have to consider other elements like how long ago was this, how much was taken indirectly from this sanctioned platform to ours.
Yep.
So there's a lot of elements to consider there.
That in and of itself could be a 3-hour discussion.
Yeah. I could talk about that for hours as well, but I won't.
But no, those are excellent points. Excellent points. So to sort of sum up everything, testing and tuning is a lot of work. Why would you do it? Well, I think there's sort of 3 main reasons why. First is, if you are running a compliance department, if you have your rules tested and tuned, you are more able to go and get the work done. You aren't stuck with mountains of false positives. You aren't dealing with issues where you have to get through a whole bunch of nonsense before you can get to the real meat of things. And fundamentally, this results in you're able to find more suspicious activity out there. You're able to get to the bad actors faster because you're able to more accurately and more quickly identify what they are doing in your system. In turn, this improves your relationships with your critical stakeholders, regardless of whether they are regulators, law enforcement, your partner banks. All of them want to know that the information you are giving them is accurate and is something they can rely on to further their own responsibilities. And fundamentally, this all has the benefit of making your compliance program much, much stronger. You'll be able to better forecast your staffing needs. We talked a lot about this. You'll be able to, know that you're not going to have backlogs because your rules are finding the activity you're looking for. And when it comes down to, describing your risk assessment, working on what that looks like, you can say, yes, we have a strong transaction monitoring program. I'd like to briefly open the floor to all the panelists before we move to the Q&A section. Just like to say, from your own professional experiences, how do you approach this and how have you used it to improve the way your compliance program works?
Well, I can jump in and also comment. John Weethorn has a cat on him, so
Yes.
he is rule tuning in real time for
Fourth panelist.
Love it. So I've actually found this to be a really beneficial experience and I've worked for a number of different types of organizations, because I think that the process of testing and tuning is also sort of hand in hand with the process of product development. And I think some of you may be like, why the heck would this have any implications in product development? But I'm a really big proponent of your compliance and AML professionals getting involved in your product design and product implementation to effectively cut off money launderers and traffickers and all of the really bad people at the knees before they even either get into your system or use your system. So really good product design is a key feature that I don't think we talk about enough, that enables us to have really good transaction monitoring rules. So I'd say, if I could leave this group with sort of my experience, and the one thing that I take away is that, don't limit yourself to just your transaction monitoring system. Understand the end-to-end flow of your funds, your data, and then make sure you understand how your products are actually working and participate in the change management and design of those products so that you can, be a partner rather than a roadblock.
In my experience, my compliance North Star has always been just remember why you're doing what you're doing. So when you're implementing rules and alerts, it's easy to get lost in the weeds and kind of get lost in the details. But for me, it's always really helpful to remember the compliance North Star is we are here to catch illicit activity and stop bad actors from using our platform. And at a super high level, that's the importance of AML compliance. I'm preaching to the choir here, but I think that's really important to keep in mind when you are implementing these systems is you're doing it to genuinely capture this activity and stop bad actors. And once you keep that in mind, everything else will come easily.
I think my final thought on this is that tuning your rules is just a critical component of your AML BSA program. And more than that, it's about what you learn from the process can better inform, to Robin's point, the product design. I always tell people our job as financial crime compliance professionals is to make life as easy as possible for all of our good customers and as friction-filled and painful for our bad customers and bad actors. So if we have certain rules where we can automate requesting information from customers or step up their risk alert rating, all the better for it. And it requires you to think not just about your AML rules or your fraud rules, but also to think about how that interacts with the business, the operations, the customers, and really have an approach. If you don't have a formal approach, you're just kind of putting band-aids on things. And my final thought, my spicy thought, don't just buy something off the shelf. Make sure you hire actual professionals
I could not
actually have
agree.
experience to tune these things.
I think all of us on this webinar can agree that you can absolutely not buy something off the shelf and assume it works. All right. There are a number of questions in the Q&A, which is awesome. Let's get to a few of them. We're close to time. I want to start with this one. As most of the countries and institutions are following global standards and risk-based approach in their way of working, how challenging is will this be to ensure the majority of risks are covered in our rules to avoid money laundering / terrorist financing? So from an international standpoint, how I would say, how do you look at different jurisdictions, and especially let's take terrorist financing as an example. How do you build out different rule sets that have to look at different jurisdiction sanctions lists? And how do you also, concurrently build out rule sets that look at different jurisdictions, reporting requirements and definitions of suspicious activity?
So I want to jump in and quickly say something on this topic. I know we're very short on time. This is one of my favorite topics.
New
Because
webinar.
I think that we have this notion in this country, in particular in banking, that all international transactions are bad, which I fundamentally don't agree with, because if you look at the FATF evaluations, the mutual evaluations from the last 10 years, you'll find that the US actually ranks pretty low. And so, I'm kind of understanding the actual risks in these jurisdictions as opposed to painting with a broad brush of international transactions bad is critically important to controlling the risk. And give you an example of this really quickly of, international customers. Everyone's kind of afraid of opening US bank accounts for international customers. Why? Because they're international. Well, if you look at some of the countries in the EU, the UK, that have really good company formation regimes, they far exceed the US in terms of what the HMRC in the UK does to validate ownership of companies and to control shell companies. So banking UK customers is actually fundamentally safer than banking US customers. But if you just look at it from a concept of international, you're kind of missing the point. So trying to understand why these things are high risk, and then also understanding what activity you're doing in that country so that you can correctly understand the paradigm you're operating in, those are really critically important.
Absolutely. I think we have time for one more question before we finish up. This is open to everyone. How do you prioritize and manage competing compliance demands in a fast-paced environment?
Be adaptable. You just, especially in the startup world, you have to be able to move at the speed of the company. If they're launching new products, you need to be on board. I really liked Robin's point about, or maybe it was John's point about being a part of building the product. That's huge. So be an active participant in what your firm is launching and the products and services, and build the compliance program around that.
John, last word.
I would just build on that and say perfect is the enemy of good. If you're a good compliance officer, you want to have a perfect program, but sometimes you just have to do ruthless prioritization to make sure that you have all your bases covered and then build from there.
Yeah. Well, thank you everyone for attending our webinar this afternoon, this morning, this evening, tonight, whatever time zone you happen to be in. This has been an amazing discussion. I'd like to thank Lauren, Robin, and John for joining me on this webinar about AML rules and how we test, tune, and manage them, and how we make sure that they are risk-based.
And one last comment, if you are interested in our next webinar, it will be scheduled for June 25th regarding state examinations. So hope to see everyone there.